Well, folks, we have stocks getting absolutely obliterated all over this market. There's 4, 5, 7, 10% moves down here today, all over the place. So in this video, I want to go through the collateral damage on that's going on out there. This is all back based upon the inflation print, essentially. Okay, the CPI numbers. I'm going to show you exactly where the inflation's really problematic here. This is something I warned people about for weeks now at this point in time, that, you know, the inflation guy is not dead at this point in time. The boogeyman is still there. Then I want to react to two videos. I want to react to Larry Summers speaking here, and then I want to react to this one where everybody's kind of giving their opinion there. Okay, so by the way, I appreciate everybody joining me. Make sure you subscribe to the channel if you're not already subscribed here. So obviously devastation all over the place out there. You look at a stock like Rocket Down. We'll get into that in just a moment. Let me just show you the numbers real quick here on where inflation's actually problematic and where it's not so problematic, right? Auto insurance. I warned everybody. I told everybody your insurance is going up and up and up. And this is a huge problem in the system. I know, because I know. Let's just put it that way. But auto insurance is going up. All types of insurance are going up massively. There's another big raise coming in May for a lot of people out there. So it's not done. Insurance is going to keep going up. A lot of people are going to see a big rate bump in May and June. I hate to be the bearer of bad news, but I just got to tell you guys how it is, okay? It's something I've been warning about. The inflation baby is not dead yet, okay? Rents are going back up and housing's starting to go back up, right? Which is obviously... those are things that I think are more fearful than things like insurance. Insurance will make its big move this year, and then that should chill out. But when it comes to rent and housing, that's a little more worrisome. Restaurant meals up 4.2%, personal care up 4.2%, earnings up 4.1%, transportation was up 4%, overall inflation 3.5% in terms of CPI number. That's very hot from where people want it to be. I mean, we're still a long way from 2, man. That's a long way from 2. Education, there's always inflation in education. Like that's always going to be pretty much positive. Medical care, guess what? That's always going to be a positive inflation number as well, right? Now, in terms of the things that went down, new vehicles slightly down, electronics slightly down, hotel rooms down 1.9%, used vehicles down 2.2%, school books and supplies, surprisingly, was down. Furniture was down 3.8%, appliances down 6.3%, airfare down 7.1%, toys were down 8.2%, and do kids play with toys anymore? No, I'm just kidding. and rental cars down 8.8%, right? So, how do I feel about this CPI report? I feel exactly what I thought I was going to feel. You know, still feeling like the inflation dragon has not been slayed yet. We still have not killed this baby. Has it been severely damaged? Yes, but we haven't won yet, and that's just a troubling thing. We you know, it'd be a great feeling if at this point we felt like we already won, right? And you can't declare victory yet, right? And that's a troubling thing. And based upon this print here today, I don't know when we're going to be able to declare victory. It could easily be another 6 months to 12 months before we actually feel like we won. We beat inflation, right? And that just kind of sucks, right? Because that means the Fed has to stay higher for longer, which, as I spoke about on many videos on the main channel, and I think I spoke about it on the reaction channel here, it definitely puts, you know, a weight on everything out there, right? And so, yeah, no bueno. But insurance is just killing it right now in terms of just hurting things substantially. Once again, your rates are likely going to be going up in the next 2 months in regards to your insurance, okay? Now, in terms of the damage on out there, I mean, it's hurting certain stocks a lot more than other stocks, right? Look at a stock like Rocket Down, over 12 percentage points here today. RH is getting devastated today, down about 10 percentage points, right? 9.6%. Redfin down over 8%. WD-40 down about 7%. You have a real estate REIT here, right? Down about 6%. Zillow's down about 6%. You have the home builders all getting destroyed today, right? And the reason all these are getting destroyed is they're very rate sensitive, and rates are likely to stay higher for longer, especially after seeing today's CPI. You know, the Fed's not in a rush into cutting rates right now. With the stock market near all-time highs and a CPI print at 3.5%, they're not cutting anytime soon. And I've warned people at the beginning of this year, I warned that there's a potential that the Fed doesn't cut at all this year, right? And I think more and more people are starting to come to that conclusion about, wow, maybe that's actually realistic. Maybe the Fed actually doesn't cut at all this year, right? And so anything rate sensitive really getting hammered hard. Safety stocks are kind of a mixed bag here today because some of those stocks, people look at it on a day like today where the market's getting destroyed and they're like, this is where I want to be, right? If we look at my potential buys, look at the two that are hurt the worst, right? I don't have positions in RH or Whirlpool right now, but I might eventually. But in terms of those ones, getting devastated, right? If we look at three stocks I'm hedged against, yeah, SQQQ's having a pretty good day out there. My Toll Brothers hedge is doing pretty well today. Chipotle, that freaking stock never can go down. It's impossible. It's ridiculous, okay? AI stocks here today. AMD's the big L of the day. And then Tesla, which is obviously rate sensitive, the most rate sensitive of any of those AI stocks. That one's getting hit hard today. Look at the banks. I mean, other than Deutsche Bank, everything is down here today when it comes to the banking system. With KRE, which is a regional bank index, down over 5 percentage points. People still are not going to feel comfortable in the small caps and the regional banks until we've defeated inflation. Or it's very obvious we defeated inflation. We're not there yet, man. We're not there. Shopify got hit really hard today out of big tech. But, some of these big techs are holding up well. Meta's my biggest position in the public count. That's holding up pretty decent today, right? I mean, look at that stock. It's actually green. Green. Look at NVIDIA. Green. You might look at NVIDIA, you might look at Meta and say, why are those stocks green? How are those stocks green when everything else is crashing out there here today? Okay? I'll tell you exactly why those stocks are green here today. Those stocks are green because this is where people want to position if they feel like we have not defeated inflation and I got to make money somewhere in the market. People go to those sorts of stocks. Safety stocks, so sometimes go to, which is some of those consumer brand type names. You got to go to the grocery store and get your jelly and your peanut butter and stuff like that, right? Some people will flock to those. Other people say, yeah, that's more recessionary. That's more like if you're going into recession, you're confident you're going into recession, then you flock to those. But people aren't really confident we're going into recession. They're just confident now, at least, right? That can change over time. But as of right now, they're confident the CPI is not dead. Rates higher for longer. Where do you position to make money? A lot of people want to position into Meta and NVIDIA in that sort of situation, right? So just absolutely brutal for so many stocks, but not Meta and not NVIDIA here today, right? Kathy Wood, watch list here today. It's pretty ugly. Coinbase is doing pretty decent. Commodities. So this is our issue, right? And I've been calling this out on so many videos recently, right? GSG. If you want to know another scary thing for our inflation, it's GSG, it's commodities basket. And this is kind of looking at commodities as a whole. And that baby is up, 14, almost 15% so far this year. That's no bueno. No bueno. WTI keeps going up. WTI is now up over 20 percentage points for the year. That is not good. These are things that could affect inflation numbers very negatively in the back half of this year. And when I say negatively, I mean it's going to cause potentially CPIs to still come in very, very hot, right? And so that's problematic, man. That's very, very problematic. Look at gasoline. Gasoline's only up 1.3% in terms of the latest CPI numbers. Folks, back half of this year, even in the summertime, we could be looking at some CPI numbers that are very, very hot because of how much commodities are running, how much WTI is running, right? Very, very scary in regards to that. Crypto, looking at crypto, Bitcoin's holding up pretty decent today considering the damage that's going on out there. The Dow 30, obviously, look at the Home Depot, the leader in terms of the L here today. If we look at Ecom watch list, Affirms, the stock is getting hit hardest, which makes sense. That one's the most negatively affected by rates. If we look at EV stocks here today, it's all Red Dead Redemption for all those guys. Look at Rivian. Rivian's flirting with going down to single digits, meaning going under $10 a share. Fintech's a mess here today outside of coin. Housing stocks, we already looked at that. Oh my gosh, what a disaster. Wow, RH is about to hit a 10% down number, folks. RH is about to hit a 10% down number here today. That is pretty epic in terms of that collateral damage. So I told you guys, I'm not scared about that one running away at all. If we look at my stocks here today, I got something green out there, but it's definitely more red than green, right? Revolve getting hit hard, Fubo getting hit hard, Honest getting hit hard. Why are those three stocks my worst stocks here today? I'll tell you exactly why. Revolve, Fubo, and Honest are my worst stocks here today. The reason those are my worst stocks here today is because those would fit into the what? The small cap. They're small caps, right? They're little companies. Well, if people are convinced higher for longer and inflation has been defeated, people get very fearful about owning the small caps, right? And so therefore, stocks like Honest, Fubo, Revolve, those ones have a lot of trouble in the short term. With that being said, if at any point in the future we can eventually get this inflation dragon slayed, obviously that could be pretty bullish for those stocks overall. But for right now, it's just like if people see a hot CPI like that, they don't want part of those stocks for the moment. That's why you see a big sellout here today, right? If we look what's holding up pretty good for me today, it's the Planet, it's Avant are doing pretty good for me here today. Nvidia, once again, we spoke about that, and Meta are doing pretty good for me. Texas Roadhouse, which Texas Roadhouse has a very nice cash position and no debt. So Texas Roadhouse, higher for longer, they're okay with that right now. Because they're making good money on that interest, right? Amazon's holding up pretty well. People like to flock into a lot of those big tech type companies and also think about it this way. Nvidia, Meta, Amazon, what do they have a ton of? Cash. They're cash loaded. What do they not have a ton of? Debt. So higher for longer, people view those businesses as they're gonna put up their numbers regardless, right? And they're going to be able to generate tons of interest income in higher for longer. And so therefore, people like to position in some of those, and that's why those stocks are holding up so much better than, let's say, like the small caps are today, and those more interest rate sensitive type stocks. My Mag 6 here today, it looks like Meta's only green, and then Amazon's flirting with green. Palantir's holding up pretty well. Why is Palantir holding up pretty well today? Well, another company that they're going to put up their numbers regardless. 2, because they deal with big companies. Big companies always have money. 2, the company's loaded with cash and no debt. Billions of dollars of cash and cash equivalents, right? And no debt. So a company like a Palantir is going to continue to make a fortune from treasuries this year, right? Because the Fed's not likely to, I would say, at this point in time, you got to assume the Fed's going to lower rates. If they're going to even lower rates, 2 times or less this year. Could it be 1 time? It could be no times. And so a company like Palantir is going to continue to pour in money through making money through treasuries, right? Which, that's why that stock's holding up pretty decent despite being a higher growth, higher valuation type name. Else doing, okay today. PayPal getting hit a bit, and then obviously Tesla getting hit very hard here today. Oil and gas stocks, look at that. Oil and gas stocks all up today, other than Valero. That's incredible, right? Absolutely incredible. And semiconductors, no bueno. And I bet you travel watch list is ugly. Why do I believe travel watch list is ugly? And we'll see. Maybe I'll be wrong. I'll get myself wrong here. Travel watch list should be ugly because companies are rate sensitive. A lot of them have tons of debt, and a lot of them are low on cash, right? Relatively speaking, compared to their debt loads. So higher for longer hurts those. Also, obviously, people eventually worry about recession. Let's see. Yes. Every single stock's red today. Every single stock, right? There's not one that's green on that whole list. Hawaiian Airlines, Las Vegas Sands, Royal Caribbean, Oobity Booba, Airbnb, Wynn, Delta, United Airlines, Southwest, Carnival Cruise Line, MGM, and then American Airlines. All Red Dead Redemption here today. No bueno. Okay. All right, guys, let's get into these videos and react to those. Oh, by the way, 4 days away, folks. 4 days away from the one-day huge sale we have for that Patreon tier, $69, usually $125. Get access to my #1 course ever. That's, especially if you're kind of newer to the stock market, this is like your first year or 2 of investing. That's a course that's designed perfectly for you, goes into everything you need to research, financial statements, how to understand it all. That's so helpful, that course. Get to see the moves I'm making, exactly how I build my portfolio in any market, right? And then get part of that Discord chat. Pin comment down there, enter your info. We'll send over the deal when it drops in a little over 4 days from now.
A very special contributor here on Wall Street Week. So Larry, great to have you with us on short notice. We've been talking about inflation on Wall Street Week for some time now. I know you're not hoping for more inflation, but you've been warning about it. What do you make of the numbers we saw today?
I was not hugely surprised by the numbers. In an economy that's growing faster than potential, with an unemployment rate that has a 3 handle, in the presence of massive and growing budget deficits and epically easy financial conditions, the idea that inflation would remain robust or even accelerate should not be a surprise to anyone. And that's what this data suggests. It was not me or some outside observer who emphasized the concept of supercore inflation, that is taking out the transitory stuff and also taking out housing. And by that measure, inflation is running at above a 6% rate, and the 3-month rate exceeds the 6-month rate, and the 6-month rate exceeds the 1-year rate. This confirms the idea that the neutral rate is way above the 2.6% level that the Fed has been using as a North Star. In my view, puts back on the table. It is still not what I would expect, but you have to take seriously the possibility that the next rate move will be upwards rather than downwards. And anything could happen. Markets could crash, the indicators could turn down. But on current facts, a rate cut in June, it seems to me, would be a dangerous and egregious error comparable to the errors the Fed was making in the summer of 2021 when it just didn't get the thread on inflation.
Larry, you mentioned the supercore that, as I recall, Chair Jay Powell, among others, has talked about specifically. It raises the issue of, are there aberrations you see in these data? We hear some people saying, wait a second, this is really housing and auto insurance. There are a couple of outliers, and that the rest isn't as troublesome. Is that right?
I don't think so. Look, you can always find particular indicators that are up or down, but when you're making up a story month after month, that's a problem.
That's a
when
good
commodity
point.
prices are spiking, and
Thank you, Larry
those
Summers.
are being taken as a market indicator of inflation expectations, when break-evens have risen, when the political economy of the country is heavily about inflation, trying to dismiss it on an indicator-by-indicator basis is an odd thing to do. Look, it is a technical subject, the price indices for housing. I don't think there are many Americans who feel like housing is becoming lots more affordable these days. They really don't. And so to argue that somehow housing isn't a source of inflation psychology seems to me to be quite a surprising view to take. Look, why are we thinking about rate cuts when the economy is below what the Fed thinks is the normal unemployment rate, when the economy is growing faster than what the Fed thinks is potential, and when inflation is unambiguously above target and plausibly accelerating? The Fed has once again, in important respects, lost its way over the last 6 or 9 months in the same way, making policy and making forecasts based on hope rather than on a hard-headed look at reality. I think that the Fed did a good job of cleaning up on the errors they had made in 2021. And I think it's reasonable to think that they will pivot off the errors they made last fall that led markets to be ludicrously expecting 6 cuts this year. And I'm hopeful that that will happen. But I think the Fed does need to learn some important lessons from this.
All right, let me push back against Larry Summers here for just a moment. Let me push back against him. Okay, listen. He calls it ludicrous that the market expected, a ton of cuts, obviously, for this year. To be fair, let's go back to the end of last year, right? We saw CPI coming down to, 3.1, 3.2, somewhere around there, right? So it was clear the trend if you want to say the trend is your friend, the trend was was our friend in terms of like thinking about rate cuts, right? So I don't think it was crazy to think there was going to be a lot of rate cuts. Now, looking back, it looks crazy to think that. But at that particular time, right, I can understand why Wall Street thought there were going to be a lot of rate cuts, because by this point, a lot of people were convinced inflation, CPI numbers are going to be in the twos. And if we got into the twos, then the Fed could start looking at cutting, right? Obviously, now commodities have boomed. You obviously have housing coming back. And so a lot of things have played out now that people did not forecast or see at that time. But that was not the trend at that time. The trend was clearly down, down, down. If you were running numbers and projections back in October, November, December of last year, you would have thought right now maybe we're at a 2.7 number, 2.8, 2.6, something like that. And clearly we're not. We're at a 3.5. So significantly above where everybody wants things to be.
Experience. Let me say one other thing, if I could, David. There's been a lot of talk about 1995 as some kind of useful analogy. I think not. The unemployment rate was 5.6% in 1995. Equity markets, as shown by the fact that they more than doubled subsequently, were not frothy, particularly in 1995. We had just come off a major program of deficit reduction rather than being in a program of unprecedented fiscal expansion. And we had really clear...
That's a good point. If I recall, the last time the government budget was actually in a good place, I believe, was in the 90s. That's how long it's been since we actually had things going in the right way when it came to government budgets and whatnot in terms of the deficit. Yeah, I believe it was the 90s. It's crazy.
Of a kind we don't yet have now of productivity acceleration. And interest rates were higher than they are right now. So the case that somehow this moment looks like 1995 and that's a reason for cutting is something that I find inexplicable. Another thing...
Yeah, I'll say it's a fool's game to ever draw back to these old time periods and be like, this was like that time period. People always do that. Oh, it's 1929. Dude, no, it's not 1929, okay? Nothing is even remotely close to being the same way it was in 1999. It's also not 1995. It's also not 2000. It's also not 2008. It's also not 2004 or any other past time period. Each one of these situations is a separate situation. 1929 was not the same as 2008. 2008 was not the same as 2000, right? 2000 was not the same as periods in the 90s. Like, all of these situations are different, which was different than what happened in 2018, which was different than what happened in 2020. Every situation is its own situation. People just, I think, as humans, we like to try to relate things to past time periods, and it makes us feel good about like, oh, look, it's all separate, man. This is our own deal. There will never be another time period exactly like this again, right? We will have bouts of inflation again in the future, 10 years from now, 20 years from now. But I can tell you how it's going to play out will be much different than how it's playing out in this time, as this is much different than what played out in past periods.
It seems to me is problematic is the notions that are increasingly being bruited about that the Fed is going to slow QT. Of course, one of the things that today's movement in interest rates, the interest rates moves that we've seen over the last month mean is that the Fed's efforts to do parity trades in the bond market have proven to be extremely expensive for taxpayers, and the length of time for which the Fed is going to be showing annual losses or on a mark-to-market basis, large balance sheet losses, that looks like it's longer than we thought some months ago. So we need a Fed that stays focused on what is very clearly the focus of the American people, which is price stability. And I'm afraid there are some signs that in the last few months they have lost their focus in favor of more ambitious economic theories about preempting slack that's not happening or some such.
Larry, you're always...
So let me tell you a very fearful thing, right? Because everybody likes to draw back to this time period and that time period. Okay, you want to draw it back to a very recent time period? You could make an argument that right now we're in late 2020, right? Where you're starting to see inflation, but no one's, now everybody pays attention to these CPI numbers and inflation numbers. But if you go back to late 2020, a lot of people weren't really paying attention to them and weren't really paying attention to what was going on in the real world. And they kind of just chalked it up, at least late 2020, early 2021, they were just kind of chalking it up as, oh, it's supply chain issues. That's why prices are going up on things, right? And that was just an easy kind of scapegoat there. And then we found out that wasn't actually all that was going on, right? But there would start to be some effects actually there and actually a rise that a lot of businesses started to felt. And so we could be in that situation, right? And that's the fear, is that, next year things are back out of hand again. And when I say out of hand, it's a situation where CPI goes above where Fed funds rate is, which would cause all heck to break loose in the markets, okay? If we saw a CPI go 5+ and we saw it get above where the Fed is at in terms of Fed funds rate, oh my gosh, panic, pure panic. This is just a warm up in terms of panic. If that were to happen right now, before you get to that point, you could have panic that comes in before, because if you even started hitting 4s, people are going to flip out. But that's a fear, and I think it's a real fear, because if you got housing starting to come back, you got commodities going on this bull run, insurance is going to be an issue this entire year for folks and for those CPI numbers. If you got rents going up, housing going up, and then if oil keeps going up, transportation of all goods, guess what? Go up. All of a sudden, getting that case of water to the store just got more expensive. Getting the tomatoes to the store just got more expensive, which caused tomato prices to go up, right? And so all these things factor in, and next thing you know, you all of a sudden have goods inflation and services inflation, and then you got a whole new batch of inflation. Then you got to start talking about, are you going to raise rates, right? And that just would be devastating. I'll just say that, okay? So let's go back into this.
Warn us that things can change, so we can't predict what's going to happen in the fall and into next year. You've said you think it's definitely a mistake for the Fed to cut in June. But given where we are right now, what you know right now, if you had to make a decision, are we going to see any cuts this year? And what is the likelihood of actually an increase?
Just to quibble with what you said, I said on current facts, I see no case for a cut in June, but facts can change. Inflation indicators could come in much lower than most of us are expecting. The economy could turn down. So never make an absolute judgment about policy several months from now, because all kinds of surprises could happen.
Fair.
I think the odds are that the next rate cut will be down rather than up. But I think you have to assign a greater probability to the next rate move being up than you did several months ago. I don't know whether it's 15% or it's 25%, but somewhere in that range is what I would say for the next rate being up. I still think the odds probably favor another rate cut this year, but not by very much, and not by as much as is priced into the markets, even after the adjustment that we have seen. So reality, markets are adjusting to reality. The Fed is adjusting to reality, but I think the process is slower than would be ideal.
Larry, let me ask what for some of us might be the scary question, which is, does the Fed have the power to get their arms around inflation at this point through monetary policy, or are there other factors that are larger than what they can really affect over the short or medium term?
I think the Fed has considerable influence over inflation expectations, which are an important determinant of subsequent inflation. I think monetary restraint does influence the economy, which feeds through into the inflation process. But gosh, we ought to be doing everything we can on...
So let's think about this logically. What can the Fed influence in regards to these numbers right here, right? Well, the truth is they can influence, let's just go by category. Can the Fed influence auto insurance rates? Okay. The answer is yes, they can. How do they do that? Well, if you raise rates high enough, no one buys cars. If no one buys cars, car sales go down substantially and the price of cars goes down substantially because then, they're just trying to sell it at whatever price. And we've seen some results of this why actually auto insurance will not be an issue for CPI next year. Next year, auto insurance is cake. Now, don't expect auto insurance to go down, but in terms of this insanity that's going on here, that won't happen for auto insurance next year. So they could actually affect that. Rents and housing, 5.7%, 4.7%, right? That's usually people's biggest expense. Can the Fed negatively affect that? Yes, but it's not playing out exactly how the Fed thought it was going to play out because prices are being very, very sticky because there's not a lot of inventory. So many people locked in 2, 3, and 4% rates, and now they don't want to move. So therefore, prices can't drop. So if anything, prices are staying high. So, and then if you're talking about higher interest rates, then there's a potential maybe not as many people will build new homes, right? There's also a potential that, there won't be as many new apartment complexes and condo buildings and those sorts of things because people will look and they'll say, like the interest rates are too high to make financial sense right now, right? Which could lead to less housing, which could lead to higher prices, right? Restaurant meals, sure. If the Fed raised rates high enough, they could cause recession, right? Recession, that's not good for restaurants. So prices would have to go down because then things have to get very competitive, right? If we look at transportation, yeah, they could negatively affect that. Education, medical care, not really. Products like that, no. Gasoline in groceries, yeah, they can. If they were to raise rates high enough and you had a major recession, then food prices would actually fall. You saw a lot of that in actually 2009, where prices were actually falling for a lot of products. I remember getting a gallon of milk in 2009 for like $1.47 a gallon in Arizona. $1.47 a gallon for milk in Arizona. I remember in 2009. And there was a lot of bad things in 2009, but food was not one of those. I think there's a lot of categories in the food category in 2009 that actually saw deflation. So the Fed could absolutely negatively affect that, right? College tuition, maybe not as much. Prescriptions, maybe not as much, right? New vehicles, used vehicles, 100% they can. Furniture sales, appliance sales, yes, all those they can, right? So the fact is the Fed can negatively or positively affect the majority of these categories. Not every single one, but the majority, the Fed can absolutely control at the end of the day.
The supply side, anytime anybody sees a bottleneck, we ought to be going after it. I am all for effective competition policy that restrains price increases. I think the most important competition policy is maintaining economic openness and allowing competition for U.S. goods from less expensive foreign goods. That's the most important competition policy. That's the most...
No, some things out of the Fed's control, right? Let's speak about that quickly here. So some things out of the Fed's control. What happens in the Middle East? And how does that affect oil prices? Fed can't really control that, right? What happens in China? If China's economy starts being seen as coming back to life, let's say in the back half of this year, then that could easily cause energy prices to go substantially higher from here, right? What happens with the Russia conflict? What goes on there, right? That can negatively affect certain things. So there's a lot of factors that are outside of the Fed's control, but at the end of the day, the majority of categories, the Fed can really hurt those substantially or help those substantially depending upon what side they want to be on.
Anti-gouging policy, that's the most important. Contain excessive profit margins policy. And so I'm sorry to see the extent of bipartisan consensus in favor of policies that are relatively protectionist. Do people really think there is an overwhelming danger that we're going to have excessive production of batteries in the world, given climate change? Do people really think there's an overwhelming danger that we're going to have an excessive effort to use solar power? If not, I worry in inflationary times about policymakers decrying the growth of capacity. And there's been a certain amount of that on Secretary Yellen's trip to China and in U.S. rhetoric on a bipartisan basis. So yes, we should complement the Fed with fiscal policies that are oriented towards restoring credibility, recognizing the defense spending that's going to need to come and allowing for it, and with microeconomic policies that are competition promoting, the most important of which is openness to the global economy with respect to goods, with respect to labor, with respect to the flow of capital.
So, Larry, you mentioned 1995 and productivity. Is there some hope, perhaps, that we could get some relief from inflation because of generative AI? You're on the board of OpenAI. We had Jamie Dimon this week come out with his letter saying it's like a steam engine. You, at one point, I think, said it was like fire. Is there a prospect that we could get some downside risk, as it were, to inflation from generative AI?
I think it's a question about horizons, David. And again, I never make completely confident predictions because the one thing we know about the economy is that it surprises us. I think that's potentially a very important factor if you look 3 or 4 years out. I would be very surprised if it was an important factor in the next year or two.
Yeah, it's not going to be an important factor for the next year or two. Probably not even the next 3 or 4 years. The next 10, 20, 30, 40, 50 years, sure. But I mean, like, you know, the problem is right now we have an inflation dragon that's not slayed. And if you're hoping we're going to get bailed out by generative AI, it's just like not understanding of like anything in the economics market.
I think the fact that artificial intelligence is a potential competitor for commentators leads this to kind of have more salience in commentary than it otherwise would. So yes, for the long run, I think this could be a huge event for inflation, a huge event for productivity growth. But I'd be pretty surprised if the effects were really large in the short run.
And I thank you for mentioning commentators and not interviewers. In that sense, I really appreciate that. One last question. It's important to Bloomberg audiences in particular. Financial conditions. You referred to the signaling of cuts last fall. Financial conditions have been sort of off to the races here. To what extent do you think financial conditions played a significant role in these numbers we got today?
Well, I think there's no question that the $12 trillion of wealth that have been created have contributed to greater spending, which has contributed to inflationary pressure. I think the availability of credit has had similar kinds of effects. So I think it's hard to quantify precisely, but I think there's no question that financial conditions have had a role. But look, David, sometimes the different indicators are pointing in different directions. This time, activity is super fast. Unemployment is very low. Fiscal is highly expansionary. Financial conditions are very loose. And on-the-ground inflation measures are above target and possibly accelerating. What is the theory of a rate cut into that configuration right now? I don't think there is one. And I think that the Fed has a communication challenge in keeping it on the table because, again, anything can happen. It can be financial accidents. There can be sudden changes towards reduced employment. There can be global developments. So never rule anything out. But I think there is a communication challenge around the fact that in the mainstream scenario, we do not need rate cuts right now.
All right, let's get into this next one. Hot CPI print rattles stocks.
From the Chicago Fed President, Austin Goolsbee. You're also going to hear from Richmond Fed President Tom Barkin. That's 12:45. So we have a little time to wait. But the good news is we can bring in our own Steve Leisman, our senior economics reporter, to game this whole thing out about what, if anything, changed today. And I think, if anything, I don't know, it validates everything that all of these Fed speakers have been saying day after day after day. No rush. We can afford to wait. Maybe we'll do it later in the year. How would you assess what today does to how they think today?
I think that's right. I do think, though, I believe it was Steve Weiss talking about this, that you do have additional risk now, Scott. Risk from two standpoints. One is that they don't cut at all, and the other is that maybe they have to reverse course. I don't think that's the next likely thing that the Federal Reserve does. I think it believes, and this is an important point, I think, the Fed believes it's restrictive. If you look at where they are now, where they believe they're projected to go this year, and I think I have a bar chart on this, and what they think the neutral rate is at 2.6%, that's the median, they think they're restrictive. They think the rates currently are in a place where actually maybe even a bit too high. There are the three numbers that I think are the key. So relative to the left side of your chart, where they're at, and relative to what they believe the long run rate is, there's, call it 2.5 percentage points in there, which means that even if inflation runs a percentage point hotter than they expect, there's still room for them to believe they're restrictive. This is the underlying belief about why the Fed believes rates can come down.
Right.
The trouble is the optics of this, Scott, and the credibility issue, which is that I do not believe the Federal Reserve will be cutting interest rates while the actual inflation numbers are stalled and not improving.
They also have to be incredibly mindful, Steve, of what...
if you want to know when does the Fed start cutting, okay, I'll tell you the exact numbers the Fed starts cutting rates. It's if you get 3 months in a row in the twos, I think the Fed will start cutting. But we're in the threes, and we're at 3.5 now. We're actually going up. We bottomed at around, 3.1 recently, and now we're up to 3.5. So we're going the wrong way in this. I think if you got 3 consecutive months in the twos, it doesn't have to be exactly 2.0. It could be like 2.9, 2.8, 2.6. Fed starts cutting right after that. But you've got to get there. And the problem is, are we getting there this year? I'm saying it's looking more and more likely we're not. With CPI coming in at 3.5 right now, and we got commodities going on a run, which is really going to negatively affect things in the back half of the year unless commodities start to sink in the next few months. If commodities crash in the next few months, I don't say crash, if they just stop going up over this next 3 months, then I think CPI is not as big of an issue for the back half of the year. But if gas prices start running, oil prices, nat gas, and all the other commodities in general, if those run into the back half of the year, it's not going to be good for these inflation numbers. And the likelihood that we'd come in the twos is not very likely, especially when you got rents going up, housing starting to go up, and you obviously have auto insurance and just insurance in general being an issue.
Happen if they wait too long to cut. Either a mistake or ruining this great story that they seem to have been able to write. The book isn't finished yet. Maybe the market and some market participants have gotten ahead of themselves trying to write the ending too early. But nonetheless, they don't want to mess the story up.
I think that's right. But I do think there's an interesting conflict here between the theory and the practice. I think it was maybe Joe who was just saying the earnings are coming in, the economy is strong. None of this should be happening. All of this violates the theory of what happens when you raise interest rates at the speed of light to 5.38%, and you don't get essentially a pop in the unemployment rate to speak of. You don't get a slowing of the economy, and you keep going ahead further. So the Fed needs to be mindful here that the theory of it being restrictive is not necessarily taking place in the reality of the economy. And that's what might put them on pause. I think one of the good and the bad things about Powell not being an economist, I'll tell you the good part, is he's not married to the dogma of the theory. And I think that means that he will reverse course if he needs to. If he sees the economy not, the way it's behaving, he'll react to that much more than he will hunker down into the theory of the fact that they're restrictive and it should be happening.
I think what we're learning too, Steve, is that this once in 100-year event of the pandemic has made it virtually impossible for economists, policymakers, or anybody else to have a full understanding about what it means to go into that kind of event and then come out when you pile stimulus upon stimulus on top of it. And then when you introduce the level of rate cuts and the speed in which they did it, to your point, you would assume things would happen when maybe they wouldn't. We're trying to get our arms around this still.
Yeah, we're all learning as we go here. And I think that requires a bit of humility on all parts, on the part of the Bulls, on the part of the Bears. We have not had the disaster that a lot of people predicted. The recession didn't happen. You're right, Scott. There are abiding concerns at some point where you're going to turn around and say, Mr. Chairman, you may be too restrictive here. Look at this happening in the economy. We don't really have this thing yet, which is really an important point, Scott. And I think we've had this discussion.
That's fair.
If I get called on for a question to the chair, I would be really happy to say, Mr. Chair, how could you be missing this unbelievably bad thing happening in the economy with your rates so high? I don't see what that is, which, by the way, I think it underpins the investment thesis on equities here, which is the investment thesis on earnings and the outlook there. But I also think, it does introduce some risks you have to be mindful of. We were talking about the idea that the March inflation numbers were not going to be what you expected. But there is, of course, an echo of last year where we had those high rates at the beginning and then it came down during the year. So if you're looking for a bullish case here, something to hang a hat on, you might say, well, there's some residual seasonality out there that will work itself out during the year and will be helpful down the road, and they'll get those numbers, just not as quickly as you expected.
Sure. The problem is you're hoping for that down the road, but the issue is you could also have commodities keep running into the back half of the year, and then that just cancels out and is a net nothing in the end, and inflation is still in the threes, right?
I appreciate it very much, Steve. Thank you. Our senior economics reporter, Steve Leisman, he's at the Fed, of course, in D.C., because we get the minutes a little bit later, and that's an interesting and important event, too. Bryn, to Steve's point on the investment thesis intact, because the expectation is that earnings are going to be pretty good, right? Expectations have come in, but HSBC today says they're still too low. That expectations are just too low. Wow. Do we start getting these reports coming in and say, okay, that's why we thought that the thesis was intact?
Yeah, I think it's going to come down to security and sector. And just to kind of build on what Joe said earlier, I think that it's easier to know what you don't want to own, to say that's not intact. So it's like you don't want to own long duration bonds. You don't want to own small cap value. You don't want to own small cap growth. It's like stick to, I think, high quality tech, which could be the Qs, individual names, energy, industrials, which I know Jim likes. And so I think you really have to pick your spots, because I do think there's going to be a big separation between the wheat and the chaff, especially in this earnings season, because the analysts are reducing estimates here. They're not increasing estimates.
No, we went from like 10 to 5% in terms of earnings growth.
But that's a 10 to 5. That's a huge deal.
I understand, but when you've been at negative earnings growth for quarter after quarter after quarter for a while, you'll take the 5.
We'll take the 5. And we all know the analysts always go too high and we come down. But I do think it comes down to these individual numbers. And I think that this market, this quarter, especially when small and mid-cap growth, will not suffer fools. And I think you're going to see, if you even slightly miss, you're going to have like a 10 to 15% down day, like we saw last quarter, by the way, and many other quarters. But I think this will be especially painful with the yield backdrop.
So on that note, I do want to get into what areas of the market may be most vulnerable, but you gave us a list of your sort of must-own areas after the CPI was released, in light of what the market's doing with the Dow down more than 500 and yields obviously up. Must-owns, according to Joe Terranova: commodities, not just the refiners, metals and materials, insurance companies, and private equity.
Yeah.
Why'd you put your list of those three?
Okay, so far, month to date, the S&P is down 2%. Are we on the cusp of a deeper decline? No one knows the answer to that. But even if we are, it is imperative that you own commodities in this environment. You mentioned energy, you mentioned metals. I would add upon that steel. Steel Dynamics is a name that's contained in the Joe T ETF. Vulcan Materials, Martin Marietta, extending beyond that. Steve, I know you've done a nice job with Archer Daniels Midland. You could throw Bungie into that. You could throw Tech Resources. Secondarily, who has pricing power right now? insurance companies have pricing power. We own.
Before we go further here, that's a trap. Insurance companies are a trap. Why are they a trap? I'll explain to you why, right? Insurance rates are going through this insane bull cycle in the short term, right? Do you think the administration is not looking at these numbers and being like, what is this? With all those companies going to be raking, record profits this year, right? Which is what we're going to see. I can tell you the administration is going to come out and they're going to talk about auto insurance companies are price gouging. We need to come down on those. They're going to put a bunch of political pressure, a bunch of economic pressure on those companies in the coming years. So maybe for a very short-term trade, if you can be very nimble and get in and get out and you play that game, right, which is not a game I'm interested in playing, maybe you can get in and get out before, things come crashing down there. But as far as like a long-term play, I don't think it's very attractive. It's a trap right now. This insanity will not last. I can tell you that in regards to auto insurance. That will not last. That's like a phenomenon that's going on at the moment, but that's not going to be going on next year or the year after. And so, yeah, I think it's a trap.
Progressive, we own Arch Capital in the ETF. And then lastly, if rates remain elevated, private equity continues to be the liquidity solution because lending standards for public credit will be tight and restrictive in that nature. That takes you to Apollo Management, KKR, Brown & Brown. Those are three areas of the market right now, even in the decline, you could go in and own.
What do we think of this, Weiss?
I don't disagree with any of that. I mean, I was having a conversation yesterday with somebody who's been in the private market investing in insurance and in auto insurance. Numbers are through the roof. The profitability is unbelievable. We looked at one company last year, which unfortunately we didn't do. That was an auto insurer, subprime. And their cash flow estimates were exceeded by 50%. I mean, those are real numbers. Look, for me, what I'm astounded by today, frankly, is that cat is flat, that deer is flat. Those would be the first ones that you would think would take gas with rates moving up. But in the pre-market they did. So if you sold it then, you lost. But right now, it's unbelievable, as well as you see with Meta. So to me, this is, I don't know if it's cautionary that people aren't paying the proper amount of attention. I could see those stocks of Meta being flat.
Maybe because they don't think that the story's changed.
Right, and I think that, again, it goes back to your fundamentals. If you're basing your buying and your portfolio positioning on rates coming down, then I think you're making a mistake. So
let's just have... If I ask you the question, is the next move from the Fed a cut or a hike? How would you answer that question?
Next move from the Fed is no move.
No. Don't give me that nonsense.
No, it's not nonsense. It's factual.
The next move that they make, that's not a move.
They're not going to do anything.
Are they going to cut next or hike?
They're probably going to cut.
Okay, thank you.
That was actually a good question. Folks, these companies, man, they're gouging. They're gouging out there. That's all I got to say. But one person who isn't, who's actually throwing deals, trying to keep deflation going on out there, which we don't have any dang deflation, is me, folks. Pin comment down there at a one-day sale, usually $125, doing it for $69 for one day only. Access my #1 course ever. Teach you everything you need to know about picking stocks and whatnot, as well as see the moves I'm making in that portfolio each week. And you also get access to that Discord chat, folks, okay? Yeah, everybody else is going up on price. I said I'm going to do the opposite. I'm doing a big deal, okay? Pin comment down there. Much love and have a great day.